Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be the 25th of September 2024, Wednesday. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Okay, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so here we go. So as a first start, let's have a recap what has taken shape yesterday in terms of news flow, economic data release, and as well as the key cross-asset intraday performance. Then thereafter, I will share with you one medium-term fundamental and intermarket analysis, followed by the short-term intraday technical outlook on the major cross-asset classes, and lastly, data or key events to look out for today that could impact those major cross asset classes prices on an intraday basis. So let us start what has taken shape yesterday. So yesterday, during the Asia session, we do mention that we do expect RBA, which is the Central Bank of Australia, to keep interest rate unchanged for the 7th consecutive meeting, which is at 4.25%, which came within expectation. And during the meeting itself, the conclusion of the meeting, the RBA press conference headed by the RBA Governor Bullock also sounded rather hawkish as well. So let's take a look at the key highlights of the RBA press conference that has taken shape yesterday. All right, so RBA actually signaled interest rate to maintain at a 12-year high, all right, for the time being. Okay, over here. Okay, 1 second. Okay, keeping the cash rate for the 7th straight meeting at 4.35%. Okay, pardon me, just now I said 4.25% is 4.35%. And RBA isn't ruling anything in or out on policy. Okay, so there's actually a rather hawkish statement. It doesn't ruling anything in or out. So that could be also a chance of a hike as well, given such statement. And also the reason over here is because Australia currently struggles with stubborn inflation on the services side. So what you could see over here is that the Aussie dollar continues to rise within our expectation and hit the resistance level that we highlighted yesterday in our short-term intraday technical outlook, we do have a bullish bias as at the 69 figure level. So resistance already may hit 69 figure level. What is the potential next trajectory on the Aussie dollar from a short-term intraday technical perspective? So I will cover that on the next component when I talk about the intraday technical outlook on the Aussie dollar. And another data to look out for will be US data. So US data, let me go over here. There was this consumer confidence data. So this is, you know, in US, right? Just has a little bit of background. There are actually two different agency or body that calculate consumer confidence, and both of them are private, not the government. Okay, the government don't actually do consumer confidence survey. So it's based on the survey. University of Michigan, where they actually release preliminary consumer confidence in every month. So the last one was released about 2 weeks ago. And another body that does consumer confidence data compilation will be by Conference Board. All right. So due to this rights issue, right, I can't see the trend of the Conference Board consumer confidence over here. There's no hyperlink, so I need to visit the Conference Board consumer confidence website to look at the trend. Okay, but what you could see over here, it was quite shocking. The consumer confidence actually declined in the month of September. This month, 98.6, way below what market is expecting at 103.8. The previous month was revised slightly upwards to 105.6, all right, from 103.3. And if you go to the Conference Board website, the reason why the September data dipped down, it was because of jobs. Okay, consumer worries about job. And if you look at the trend of the conference board, this is the data. It has been slowly inching downwards since the start of the year, but haven't break down yet. There's no lower low, but we see a series of lower higher. So indicating that consumer confidence as compiled by conference board is getting softer due to consumer getting worrying about the job situation. So we know that this conference board consumer confidence data is something like a leading data. Why? Because in any signs of a softness in conference board consumer confidence data, it will give a leading indication that it will slow down retail spending. Once you slow down retail spending, it will actually lead to slower services activity growth in US. And we know that close to two-thirds of the US economy is driven by services industry or services activity rather than manufacturing. And what you could see very interesting over here is that in the previous recession before the pandemic, it was caused by the pandemic, the conference board consumer confidence data start to see a series of lower high first over here. Okay, that's a series of lower high. All right, so right now we see a series of lower high as well. So something to take note of. Why? Because if this consumer confidence index continue to see lower low next, that means i.e. there's a chance that the US economy has already been in inflation, no, has already been in recession, pandemic recession. The Fed is late in the game of cutting interest rate, and that could be rather not so rosy for the US stock market. So if you look at the US stock market yesterday performance, yes, we know that S&P start to print marginally higher high and hit a record high over here, but the higher beta Nasdaq 100 can't even break above the 20K level that was printed on last Friday or last week or so, still struggling to break above the 20K level. So given some signs of what I call hesitation by the bulls to push prices up higher, very similarly for the Dow Jones Industrial Average, about it can't break above a fresh new all-time high yesterday after breaking fresh all-time high last week. And the Russell 2000 was rather lackluster at 0.17%. All right, so net overall, due to this lackluster conference board consumer confidence data, the higher beta Nasdaq 100 index failed to break marginal new high. All right, and going down the road over here, we do see the very strong performance of Hang Seng Index yesterday due to that very we call it a synchronized put it away that simultaneous interest rate cut by various monetary policy toolbox that people see ignited. So they cut the 50 basis point on the reserve requirement and another 20 basis point on the 7-day repo rate, and they hinted that the required reserve ratio, the RRR may be cut further down the road by 25 basis point and 50 basis point before 2024, and so that just spike up a liquidity rally in the Hang Seng Index and the other Hang Seng indices as well. Later I'll touch more about the Hang Seng Index over here because it seems to me that from a technical perspective it's getting overstretched yesterday, and with our said resistance level has been met. Okay, and also given that due to the weakness of the conference board figure over here, okay, the US Treasury real yield continue to push down lower, okay, and that caused gold price to actually break new fresh record high, clearing above that 2,740 level. So if you look at the price of gold right now, okay, gold price over here, okay, is trading at 2,664, clearing above our 2,640 short-term resistance that we highlighted. So we got to actually respect the trend of gold. Okay, look at the 5-day price. Okay, going to inch higher. Okay, breaking above that 2,040 level over here. Okay, the gold price at this point in time, we broke this level. So what we could see later, I'll share with you all what is the short-term intraday technical outlook chart, and as well as people wondering, is this the major peak of gold where we will start to see a potential multi-week corrective decline? So I'll answer that during the fundamental and the intermarket dynamics. All right. So with that, and before we go on the FX market, yes, now it's still on the intraday technical movement. So on the intraday technical movement on the FX market, right, what we could see over here is that the dollar index actually broke below this range support level that has been in place since late August, 22nd of August. And prior to that, it failed to actually surge higher and continue to see a series of lower high. And there's a bearish breakdown from here. So what we could see over here is that this could be a bearish breakdown of a bearish pennant configuration. Okay, so it's like a pennant over here, like a mini triangle or a mini descending triangle, and potentially now price action could resume its short and medium term downtrend as it continues to hover below the 20-day and the 50-day moving average. No clear signs of a bullish divergence in the daily RSI yet. So this is the daily chart, and also the US 2-year Treasury yield minus the 2-year yield is a weighted yield against the other rest of the major developing economies: Germany, UK, Japan, Canada, Swiss, AU, Australia, and China continues to plunge downwards. That means the attractiveness of holding US 2-year Treasury note is getting lesser and lesser by the day compared against the rest of the world. So that also supports further dollar weakness. All right, but if you were to break down the individual component of the dollar against the other currency over here, what we could see over here is that yes, the dollar is getting weaker against the other currency. It means dollar weak against the other currency, but however the dollar is not so weak against the dollar yen, because from a technical analysis perspective, the dollar yen now is still in the midst of a mean reversion rebound that hasn't been ended yet. So later I'll touch on the chart of the dollar yen, okay, to share with you more perspective from a technical analysis approach. So what we could see over here is that the dollar yen now is the outlier. That means the dollar is not weakening so much against the yen. In fact, it's trying to shape a rebound, whereas the dollar is weakening against the other major currency like the Swiss, the Euro, the Sing dollar, the CNH, CAD, Sterling dollar, Aussie dollar, and Kiwi dollar. Right, on the 5-day rolling performance basis. Okay, so this is kind of a 5-day trend, not intraday trend over here. Now, with that, now let us now turn our attention, our focus now to the short-term intraday technical outlook, starting with the FX market first. But before that, let me expand my screen so that you guys have a better visualization of the chart that I'm going to share with you all. All right, so now with that, let us focus our attention to the euro dollar. Okay, over here. Okay, the euro dollar. So euro dollar yesterday we were neutral between 111.45 and this 110.90 slash 110.70. So what I could see over here is that now the euro dollar has indeed staged that bullish breakout above the upper neutrality limit, and now we got to respect this strong push up into the euro dollar to resume its impulsive up move within its short and medium term uptrend phase, because price action going to trade higher low above the 20-day and the 50-day moving average, clearly indicating that the short and medium term uptrend still remains intact. All right, so right now the hourly RSI is really in the overbought region, but there's no bearish divergence, so indicating that the bullish trend on the intraday basis still remains intact. So potentially there could be some signs of at least a minor pullback first before the rally resume, the intraday rally resume. So minor pullback level potentially could be looking at this zone here, 111.77, and potentially this level here, 111.60. So 111.77, 111.60. This will be the first support zone to watch in this pullback. And by right, technically speaking, the pullback shouldn't surpass below yesterday's upper limit of the neutrality range. Now turns into a pullback, key short-term pullback support level, 111.45. So I'll be using this 111.45 as my short-term pivotal support level. We will flip to a intraday bullish bias for today, back again on the euro dollar. First resistance level 112 figure level, above it sees 112.35, followed by 112.85 slash 113 figure level. So why this level 113 figure level is very important? If you were to go to the weekly time frame over here, let me expand my screen. This is the very long-term circular descending trend line that is in place since April 2008 high. Okay, now acting as a resistance at the 113 figure level. Okay, so this level very important on the euro dollar. So now, however, if price starts to break down below 111.45, then that would invalidate today's intraday bullish bias on the euro dollar to see another round of choppy minor corrective decline to retest the 20-day moving average again at 110.90/70. Only a breakdown below 110.70 may expose a much more deeper minor corrective pullback towards 110.50 and even 110 figure level, which correspond to the rising 50-day moving average. Pardon me. Now, what's up next on the sterling dollar? So the sterling dollar also clear above our short-term intraday neutrality range yesterday that we have at 3360/3380. Very clearly, it broke above this level. On the RSI, there is no signs of a exhaustion because there's no bearish divergence. Price action going to trade higher high. Okay, there's a higher high in line with the price action. So with that, we'll use yesterday's upper neutrality range now turns into a pivotal support level 133.60/133.40. So that is actually yesterday's European session low as well, and in fact also, yeah, the entire day low. So this was the lowest point that was formed yesterday, 33.40. So as long as this 33.60/33.40 minor short-term pivotal support holds in any chance of any potential pullback, we will still maintain our intraday bullish bias on the sterling dollar. Above 133.35 exposes 134.90/35.20 next. Then thereafter, a breakout above 135.20 may expose the two-time Fibo extension at 136.10 and the graphical resistance at 136.30. So let me put it in writing. So this will be 1.3610/3630. Okay, put it in there. Okay, so if you look at it graphically on the hourly, you can see very clearly. You go to the daily time frame. Okay, this 136.30 will be this medium-term swing high area of 2nd of February and 22nd of February 2022. Very clearly, this level resisted, then the price sell off during that period in time. Okay, so now back to the hourly time frame. So only a hourly close and a breakdown below 133.40 that would invalidate today's intraday bullish bias on the sterling dollar to see another round of choppy decline to retest the next near-term support level at 132.50, which also correspond to the lower limit of this minor ascending channel that is in place since 11th of September 2024. Okay, only a breakdown below 32.50 open up scopes for a deeper minor corrective decline to expose around the 20-day rising 20-day moving average, very close to the next graphical near-term support at 135.50 level. Okay, so that's for the sterling dollar. Now, turning our attention next will be the Asia Pacific currency, starting with the Aussie dollar first over here, the Australia dollar. So on the Aussie dollar over here, what we could see on the Aussie dollar is that price action already hit the 69 figure level. Okay, and there's a bearish reaction of it. So what you could see over here, why this 69 figure level is important, if you go to the daily time frame chart, is in fact the former medium-term swing high of 15th of June and 13th of July last year that got rejected twice, and price did a multi-week sell-off over here. And also, if you look at this 69 figure level, it also correspond to this long-term descending trend line that I drew from the high of 25th of February 2021 high. Pardon me. So given the fact that there is a risk right now of the Aussie dollar to actually do at least a minor pullback, all right, a minor pullback towards the lower limit of this minor descending channel, I think as a support at 68.25. So what I could do over here is that I will use a slightly higher level, 69.20. So 69.20 will be my short-term pivotal resistance for today. As long as this level is not surpassed to the upside at 69.20, we will flip to a intraday bearish bias on the intraday basis only for a minor pullback scenario to unfold. First support level to watch in near term will be 68.25. The minor V-shaped recovery that was seen yesterday on the intraday basis at 3 p.m. Singapore time. Okay, yesterday means during the start of the European session, where price action do that V-shaped bounce. Only a breakdown below 68.25 may deepen that minor intraday pullback scenario to expose the next near-term support level at 67.86, which is the minor swing low of 19th of September and 20th of September, tested twice over here. But however, if price action starts to break up above 69.20, the upper limit of this minor ascending channel, then that intraday bearish bias for that minor pullback scenario will be invalidated to see the continuation of this impulsive up move to take us up higher towards the next resistance level at 69.80, which is the Fibo extension of 1.236 and 1.382 at 70.10. And if you go to the daily time frame, that also confluence with some graphical resistance level as well. So 70.10 is in fact the very clear medium term swing low area of 9th of February 2023 and 14th of February 2023 over here. Okay, this particular sell off that took shape during this period in time. Okay, so that's sum up the short-term intraday technical outlook on the Aussie dollar with the risk of a minor corrective intraday pullback below 69.20 short-term pivotal resistance level. Now, turning our focus now will be the dollar yen over here, the dollar yen. Okay, so this dollar yen continues to bounce above the 73.70/73.16 short-term pivotal support that we highlighted yesterday. So yesterday it tried to test again that minor resistance level of 145 figure level before that sell-off took shape during the US session, but managed to survive again at the 20-day moving average and the lower limit of this minor ascending channel that I drew from the low of 16th of September. So a bit of excess, so still no change. 43.16 short-term pivotal support level, looking for it to actually shape that recovery scenario in first step. So it got to clear above that 145 figure level before exposing 145.40, followed by 145.95 next, which is the upper limit of this minor ascending channel. So IE still maintain that intraday bullish bias on the dollar yen. However, if it starts to break down again below 143.16 level, then we could potentially see a revisit of that 141.40 level on the dollar yen. So still maintaining that intraday bullish bias on the dollar yen. All right, so that sum up the intraday technical outlook on the major dollar pair over here. So my apologies, just now I forgot to cover the fundamental and intermarket dynamics on share with you all. So the fundamental and intermarket dynamics on share with you all is in fact related to gold, XAU/USD. So a lot of people are concerned whether gold is this whatever high that we see over here, 2661, a breakout. Is it a failure breakout above 2640 yesterday, where price action might start to collapse back again, to do a multi-day corrective down move or even a multi-week corrective down move? To answer that question on a perspective, we need to do a intermarket dynamics using the opportunity cost of holding gold, which is the 10-year US Treasury real yield, okay, minus off inflation expectation. So what I could see is that there was a major breakdown on the key major resisted support level, formerly this main mid swing low area of December 2023 last year and early February 2024 at 1.62%. And price action actually did a pullback yesterday, a couple of days ago, pullback, come break above the 1.62% and shape a bearish shooting star candlestick pattern yesterday. Right over here, there was a bearish shooting star candlestick pattern, reaffirming that this 1.62% level, there is no reintegration above it, and also reaffirming or reconfirming or reinforcing that major bearish breakdown in the US real yield, Treasury real yield, indicating that there's potential further movement towards the next support level at 1.38%. So given that if the US 10-year Treasury yield now has a higher odds of shaping that potential downside trajectory to 1.38%, so what it means that the opportunity cost of holding gold in the long term is getting lesser and lesser, and that actually supports firmer gold price action going forward. That means reducing the odds of a failure bullish breakout above 2640 yesterday. indicating there's higher chance that this ongoing impulsive up move in gold may continue going forward. Okay, so that's the fundamental and intermarket dynamics I want to share with you all pertaining to gold price. All right, so with that, since we are talking about gold, now instead of going to the major stock indices first, let us juggle a bit and now switch to the intraday technical outlook of gold first at this juncture. So for gold over here, let me go back to the gold chart. Okay, so for gold, if you look at the intraday chart on gold, which is the hourly time frame over here, okay, what we could see for gold over here right now is that the price action starts to break out above the 2,640 level yesterday. Okay, so now there could be a chance of a minor pullback over here, minor pullback. So what we could do over here is that this minor pullback could retest the 2,640 level again. Okay, over here a deeper minor pullback 2,640. So as long as, okay, let me expand on that. As long as this 2,640 holds in today minor pullback level, the next resistance level to watch out for will be at, now it's playing at the 2,664, will be at 2,692, followed by 2,709/2,715, which is the Fibo extension of one time 1.236 followed by 1.382. However, if price action starts to break down below 2,640, then today's intraday bullish bias will be invalidated to see a much more deeper minor corrective pullback to retest 2,615 followed by 2,591, which is the lower limit of this minor ascending channel that I drew from the low of 9th of September. All right, so that sum up the intraday technical outlook and the key levels to watch on gold. So we will flip to a intraday bullish bias given yesterday breakout of the 2,640 level. Okay, now with that, let us now shift the focus back towards the major stock indices, starting with the Hang Seng Index first. So the Hang Seng Index yesterday continues to rally and hit all our resistance level. So now it come very close to the swing high area of 20th of May 2024. Okay, and given that the RSI has also hit a very extreme overbought level, so this extreme overbought level is the highest in almost in a year over here, and now has really reintegrate back below the overbought level, below 70. So indicating there is actually a risk of a minor corrective decline scenario taking shape, and also the current movement of the strong push up has really hit the 1.618 Fibo extension level as well, that I drew from the low of 5th of August, project it to the high of 30th of August, and from the low of 11th of September. Also correspond very closely to the 19,890 swing high area earlier on. So with that, I'll be using 19,890 as my short-term pivotal resistance for today. Potentially, there could be a chance of a minor pullback. First pullback support level to watch will be at 18,980 level. All right. So only a breakdown below 18,980 could potentially expose a much deeper pullback towards 18,430 level, former minor swing high area of 20th of June and 12th of July this year, now turns into a pullback support, and as well as the gap up level as here as well on Tuesday. Okay, but only a breakdown below 18,980 may offer scope towards 18,430. Okay, but however, if price instead of coming down and from here it starts to do a turnaround and break above 18,000, 19,890 for hourly close above it, then we will respect this very strong impulsive up move that will invalidate today's intraday bearish bias for that minor pullback scenario to see the continuation of the impulsive up move sequence to expose the next resistance level to 20,270 followed by 20,730, which is close to the 2 times Fibo extension as well, and graphically is this resistance area over here. If we go back, okay, 8th of May, 21st of July, followed by this swing high area of 31st of March to 18 April last year. Okay, so this is how I derive my next resistance level if the 19,890 breaks up on the upside with an hourly close above it. Okay, so that's for the Hong Kong 33. Now, Nikkei 225, Japan 225. Japan 225, we do have a bearish bias, short-term bearish bias today. Price actually indeed hit the first support level, but can't break out and start to shape a bounce around it. And the way it bounced around, it bounced off from the key moving average of 200-day moving average, a longer term moving average. And after shaping a lower low yesterday at our first support level, the RSI shaped a higher low. So indicating that the bearish divergence that was seen yesterday has died off, and price has started to potentially reverse up from the first support level and the 200-day moving average. So indicating that there's a sign of a short-term recovery taking shape on the Nikkei 225. So with this positive technical element that is playing out right now on the hourly chart of Japan 225, we will reduce our conviction for that bearish bias yesterday to break below the 37,880 and visit the 37,410 level. So instead, right now, we will flip back to a intraday bullish bias using 37,880 as my short-term pivotal support level. As long as this level holds, there's no hourly close below it. Potentially, we may revisit this Monday minor swing high area at 38,620 in first step. Only a breakout above 38,620 potentially sees the next resistance coming in at 39,270, which is the swing high area of 31st of July. But however, if price action starts to break down below 37,880, then this intraday bullish bias will be invalidated to see the continuation of this corrective decline, minor corrective decline scenario playing out, to see the extension of the fall towards the next near-term support level at 37,410, followed by 37,090. It's a zone that confluence with the 50-day and the 20-day moving average as well. So that's for the Japan 225. Turning our attention will be the German 30. So the German 30 managed to actually pause or shape a store right at the intraday short-term pivotal resistance to be highlighted yesterday, 18,970/19,050. So with that, unable to break out above 19,050, we will still maintain our short-term intraday bearish bias for the German 30. First near-term support level to watch, 18,820. A breakdown below it exposes 18,690. We also confluence with the rising 20-day moving average. Only an hourly close above 19,040 will invalidate today's intraday bearish bias to kickstart another round of impulsive up move sequence towards the next near-term resistance level at 19,230, which is a one-time Fibo extension over here. Above it, may see 19,325/19,440 next. So that's for the German 30. Turning our attention will be the major US stock indices, the US Wall Street 30. So rather sideways movement, still can't break above the upper limit of our neutrality range that we highlighted yesterday, 42,335/42,410 level. So still keeping the neutrality bias on the US Wall Street 30, neutral between 42,335/410. Lower limit will be 41,950. Only a breakout above 42,410, then we will see another round of impulsive up move sequence towards the next near-term resistance level, 42,730, followed by 43,170 next. So that's for the US Wall Street 30. The Nasdaq 100 again tested the 20,000 resistance level, upper limit of the range, can't break out and starts to go sideways. So we're still keeping that neutrality stance on the Nasdaq 100. Neutral today between 20,000 and 19,630. So need to have an hourly close above 20,000 before potentially we could see the start of a much more pronounced rebound scenario taking shape on the Nasdaq 100 to expose the next near-term resistance zone on 20,170, followed by 20,360 next, which is this congestion area here. 5th of July, 11th of July, and this 16th of July, 13th of July, or 12th of July, pardon me. So that sum up the intraday technical outlook on the major stock indices. So lastly, we will talk about West Texas crude oil. So West Texas crude oil continues to actually struggle to break out the 73.15 short-term pivotal resistance level that we highlighted yesterday. So still no change, still using 73.15 short-term pivotal resistance level, still maintain that short-term intraday bearish bias. First support level to watch out for will be at the 71 figure level, which is the minor swing low of Tuesday, pardon me. Only a breakdown below 71 figure level may see further weakness towards the next near-term support zone of 69.90/68.90 next. Right, only an hourly close again back up above the 73.15 level that would negate the intraday or invalidate today's intraday bearish bias to see a squeeze up to expose the next near-term resistance at 70.07, which correspond to the declining 50-day moving average and the upper limit of this minor ascending channel that I drew from the high of 18th of July. Okay, 18th of July. Okay, so that sum up the intraday technical outlook on oil and as well as all the various major cross asset classes. So before we go, let's take a look at the economic calendar on what are the data to look out for today. So for today over here, just a while ago, we do have the monthly CPI data release over here, which came in below than expected at 2.7% over here, and also market expecting 2.8%, also came down way below 3.5% that was printed in the month of July. So that's what explained why the Aussie dollar boost was hesitant to break above the 69 figure level as well. Earlier just now I shared with you the chart of the Aussie dollar. Then going to the European session, there is no clear key economic data to look out for, except that we do have a European official speaking at 8:30 p.m. Singapore time, ECB Macau speech. Second tier US data will be home sales data, new home sales data for the month of August out at 10 p.m. Singapore time. Then thereafter, pertaining more to the West Texas crude oil market, is the weekly EIA crude oil stockpile change on a weekly basis for the week ended of 20th of September. Then thereafter, during the US session, will be rather quiet, nothing interesting to take note of over here. So that would sum up today's intraday, we call it short-term daily dose of market insights for me for today. And as we know that tomorrow I'll be off and Friday as well. So I will see you all next again on next Monday. So just bear in mind that tomorrow and Friday there'll be no daily dose as I'm off to settle some home stuff, and we shall speak again on next Monday. But before we go, one important news to share with you all is that Fed Chair Powell will be speaking at 9:20 p.m. on Thursday. So just to bear in mind of for tomorrow as well, since tomorrow there'll be no daily dose, I'll be giving us a head starts for the news flow that is important on Thursday, 26th of September, will be 9:20 p.m. Fed Chair Powell speech. So with that, I wish you all a great day ahead and do have a restful weekend as well. And we shall speak again on next Monday. This is Kelvin here, signing off. Thank you.